Hello, everyone, and welcome to the 2023 Executive Briefing Mid-Year Review. Today, we have with us Pat Albero and Dan Argiro from Performance Brokerage Services. Performance is the largest volume brokerage firm in the industry with over 900 transactions closed in the last 25 years. Pat and Dan run the equipment division for Performance, helping dealers buy and sell dealerships across the United States and Canada. Pat and Dan have over 35 years combined in the equipment industry, working with dealers and OEMs. They're currently working with a number of dealers who are exploring a sale, and their most recent closing was with a Kubota dealership in Michigan. Pat and Dan always welcome the opportunity to help educate dealers on the buy-sell process and are excited to be on our webinar today. Pat and Dan, thank you so much for joining us. I guess to kind of jump into our questions, just wanted to start off with what's the buy-sell machinery market look like currently?
Well, thank you for having us today. We are excited to talk to everyone on the call today. We do everything that we can to try and help the industry and the dealers move forward. That's pretty much our mission is education. Great question. What's the buy-sell machinery market look like today currently? So in today's market, the buy-sell mentality is still very strong. There are more buyers than sellers, so it's still very much a seller's market. The value of the dealerships are still up despite what we're seeing in the economy and the crazy rise of interest rates in the last 12 months. Buyers are still very hungry for deals. We're getting calls weekly from dealers looking for acquisitions for other dealerships.
Okay, and then how does it compare to 6 to 12 months ago?
Yeah, so 6 to 12 months ago, most dealers were still in allocation. So we're starting to see that move off that mark a little bit. Good quick story is we were at a large dealership here recently. Dan and I travel across the US and Canada, and the large dealer had mentioned that they were picking up allocation from some smaller dealer groups that had canceled orders. So that shift has begun a little bit, but obviously something we have to work through over the next few months. But the profitability over the last 6 to 12 months from COVID were record sales for most dealerships. So what that's led to in the merger and acquisition world is there's more cash on hand for those dealers to expand via acquisition without having to worry about the rising interest rates. They have the cash in order to make the moves.
Okay, and then how do business owners determine if they should exit now or if it would be better to wait a few years?
Yeah, so this is a touchy question. You know, Dan and I are a family-owned and family-run business, and we look at it as really starting that process is to know what the value of your dealership is first. Once that's done, you can fully explore really what the next steps are, but I would recommend not really going down the path of what a sale looks like until you know what the value is.
Right, the sale price of your business is one thing, but it's about maximizing the value. So a lot of our dealers have an idea of what they think the dealership is worth, but what is the maximizing the value of the dealership in the marketplace today with having multiple buyers take a look at it, not just one buyer. In the one buyer scenario, we like to call is a one buyer, no buyer situation. But the bigger factor here is you could get way up here for your dealership, but what is the number for you and your family after taxes, after paying off your debts? We like to call that the net number. What does that look like? So understanding what that number is, what that value is, and what you and your family need for the rest of your lives, that's what we're really concerned about. It's not the top line number. It's not what the value of my dealership's worth. There's a lot of, we see a lot of times, a lot of unlocked value in a dealership that comes with the execution of a sale. So it's the full understanding of the picture with the beginning of what's my dealership worth, what's the value that's tied up in there that my family or my generations of families have worked for all these years.
Okay, and then for a business owner, what should they start planning and how long is that process?
So great question.
Or when should they start planning? Sorry.
A great question. So the first thing that needs to be done is the team. For example, if you're going to go out and play a baseball game, if you're going to play a football game, you're going to play a soccer game, well, you can't just do it by yourself. You got to have a team around you in order to make that happen. So what we suggest is, in our professional advice, is to start building that team if you don't already have it, or maybe you kind of have the beginning of a team, but it's not really built out. And that team's made up of a few trusted advisors within that group. First one's a CPA. a CPA that has mergers and acquisitions experience, not just taxes, but have worked through the buy-sell process, a buy-sell advisor, a broker that you trust, an investment advisor that you trust, an attorney that also has buy-sell experience, not just, hey, I can talk about contracts or I can do this. We don't want anybody to learn on your time and your dime, right? That makes a big difference because they're billing by the hour. So CPA, good buy-sell advisor, broker, an attorney, and then a financial or wealth planning company or expert that's going to help you with that net number we're talking about, and then give you the opportunity to build on that over time. That's your team.
Yeah, and just to kind of go backwards a little bit too to what Dan had said. So you've got the value of your business now. You know what the market might bear. You've built your team in the sense of your CPA, your attorney or your lawyer, your wealth management advisor. At that point, once you have that framed up, you then know what you need net in order to be able to lean into retirement safely and in a healthy way. Then you can start framing up the time to consider an exit. We have families that call us, and it's truly an exploratory process. Should my son or my daughter take over? The answer is yes. Mm-hmm. If that's possible and that meets your needs, then absolutely, let's go down that path. Mm-hmm. If not, what does it look like to go outside and find multiple qualified, factory qualified buyers? We have that list. We only talk to dealers every single day that are looking to acquire dealerships, but bringing to them under confidentiality is a huge factor to be able to make sure the dealership doesn't get hurt in the long run.
And we've got to think about transaction time too. The average transaction is 4 to 6 months. The fastest one we've ever done is 6 weeks. And I think that because it was Christmas time and everybody wanted to go away. But sometimes it can take a lot longer than that depending. So if you were going to sell your business today, from the time that we talk until the time you would get a check, it could be 6 or 8 months because there's a run up to the actual beginning of the process when we would go to market or even selectively go to market to certain dealers.
Okay. And then what would the next step be?
Yeah. So on our end, everything we do is, for the most part, again, is based on education. So I think coming out of this session, we would love to share our buy-sell guide. It's a full comprehensive step process through the buy side or the sell side. Additionally, we'd like to offer a complimentary 30-minute consultation just to begin to start that exploratory process, rather it be today or in 10 years from now, would be a good starting point. And then thirdly, again, another complimentary item would be an opinion of value and something that we can provide to give a good baseline to what the market might speak to in the sense of evaluation.
And the consultation is really a conversation. We say consultation, it's a conversation. We've done it across the board. Even if they're looking to buy a dealership, or maybe the idea of considering a sale, or like we talked about earlier, having my son or daughter is thinking about taking over. We can walk our dealers through that process. And, are they really passionate about the business? Is it something that they see themselves engaged in, like you were, or your father, or your grandfather was? So it's really just a conversation. And then the opinion of value is important because it gives you an idea of where the nooks and crannies are that can unlock some of the value that you may or may not know and that's there. We've seen it both ways. Like, I think my dealership is worth this, and when we get down to it, it's really not, which means, hey, we need to have a conversation about you continuing to run things, or maybe buy another dealership in order to get you where you need to be. Or, well, I think my dealership is worth this, when really it's worth this. And you're like, holy cow, that accelerates my time frame. You're kind of like hitting the lottery on a scale where I didn't realize all that was there. I can go ahead and think about retiring now. My family would be so happy, or I can really accelerate my timeline for my goals. But it's important to know that all of the conversations that we have 100% are under their strictest confidentiality. Our reputation relies on confidentiality, and our clients' businesses rely on confidentiality.
Okay. Well, that was all we had for this little bit of an introduction to the status update on M&A activity. Thank you both so much for joining us for this year's mid-year review.
Thank you for having us. Have a great rest of the year.
Thank you again to Pat and Dan and to Performance Brokerage Services for their support of today's Ag Equipment Intelligence Executive Briefing Mid-Year Review. If anyone's interested in the hard copy of that roadmap to buying and selling an equipment dealership that they mentioned, please reach out to me at kschmidt@lessitermedia.com, and I can get you all set up with that. Now on to our panel discussion. We have 4 different speakers with us today who were part of various panels during our December's executive briefing. We've brought them back for an update on the year so far. And joining us are Joel Dawson with John Deere, Mary Henry with Messick's Farm Equipment, David King with Artsway, and Mark Adams with GBGI. Thank you all for joining us. So I guess before we get into our questions, I'd just like each of you to kind of give a quick, 10-second introduction of who you are and your company. Mary is the last one in. Do you want to start us off?
All right, sure. Good afternoon, everybody. My name is Mary Henry. I'm corporate sales manager with Messick Farm Equipment. We're headquartered in Mount Joy, Pennsylvania, which is in south central Pennsylvania. We are a 5-store New Holland, Kubota, and Krone dealership in our 3rd generation of family ownership.
All right. Mark, how about you next?
Yeah, good afternoon. Mark Adams with GBGI Incorporated. We're out of Chardon, Ohio. We are a family-run business. I've been in business almost 30 years, and we focus on manufacturing hub and spindle assemblies for short line OEs for planting and seeding equipment and tillage equipment, and then also on machining planter wear parts, so disc openers, parallel arms, gauge wheel arms, etc.
All right, and David?
Yep, Dave King, CEO of Artsway. We're in Armstrong, Iowa. We make mixer grinders, manure spreaders, some bale processors that mount on the skid steers, and we got some land engaging equipment, graders, land planes, and then we also make some sugar beet equipment for the Red River Valley and out west in Idaho.
All right, and that leaves you, Joel.
You bet. Joel Dawson from John Deere. I'm the Director of Production and Precision Ag Marketing for North America. So anything big, green, and yellow or technology-based, I have responsibility for the go-to-market for John Deere.
All right. So just for all of our attendees, we've got some planned questions that we're going to be working with, but feel free to submit questions using the Q&A tool in Zoom, and we will try to get to some of those questions as well, depending on how long the conversation's going. So I guess to start off, Joel, maybe we'll start with you on this one and then kind of work our way through the group. How was the first half of 2023 compared so far to what your expectations were for how this year was going to go?
Yeah, great timing for this question. We just had our quarterly earnings release here a couple of weeks ago. I can tell you, first half of 2023 was very strong for us, and you would have seen that in those results in mid-May when we released them. October is our fiscal year end, so we're a little more than halfway through the year, but really strong results to date. As I look at the second half of the year, we're also really encouraged, and we see robust demand within our order books and our sold ahead positions. It's providing visibility through the end of our fiscal year and even beyond in some cases. So feeling really good. All the operational results that we've achieved here have been a joint effort of our employees, our dealers, and our suppliers. And they've just really remained committed to providing our customers with the best experience we can, considering the dynamics of the past few years. So they stayed very focused, and it's really helped us deliver and really plan to deliver a really strong 2023.
Okay. Dave, we'll go to you next.
Yeah, I would echo a lot of what Joel says. Our start of fiscal 23 has been very strong. Our backlog is very big at the moment, and we are, from the sales perspective, we are really ahead of our budget for the year from what we thought. We expected an increase, and we have had it and more. I think our challenge continues to remain supply chain to get the product actually built and out the door. While our supply chain is much better than it has been the last year, instead of missing 12 parts to complete something, now you're missing 2 or 3, but you still can't get it out the door until those 2 or 3 show up. But it is certainly a lot better than last year. But the demand remains strong, and we'll definitely finish out the year ahead of budget as long as our supply chain will keep up with us.
All right, Mary, how about you?
Thinking back to our conversation in December, we still anticipated, additional price increases, and obviously interest rates were rising and, continued to rise. So, I remember, looking at that and, trying to determine, that balanced out with, continued pent up, the demand, farmers who we may not have had availability of equipment. So we've seen, the first half of our year, actually, be relatively strong. It is not as strong in terms of units sold compared to last year, but where we balance, we take a look at, where we're at market share wise to make sure that in terms of, the deals the things that are happening, that's still continuing to line up with where we should be, either, staying steady or increasing. So what we've definitely seen is farmers, those that were in the market to replace, definitely took a hard look at justifying, that purchase, making sure that it was vital to the operation, before they spent the money. We definitely, continue to see the used market, remain relatively strong, but we're seeing some, changes in that, where turn times are a little bit longer, some slower turns. And then we've got some pockets of dry, which I won't get into a lot of that at the moment, but that has tempered. We had a dry winter. And, we've got some rain early spring, but we've been extremely dry in May. So we're actually dry going into the summer months. So that's kind of changed, that'll certainly change how we're looking at things for the rest of the year.
Okay, and Mark?
Yeah, we had to start our fiscal year. We had record months. We're kind of unique because not only are we a supplier, but we also have quite a few suppliers as well. We're obviously bringing in bearings for our assemblies and steel and cast iron. So we've really relied on the support of them. Along with that, we've put up 40,000 square foot expansion to help us up our capacity with some of the shortages in the supply chain. We are continuing to see good numbers on both our OE side. And again, we primarily supply the short liners on the OE side, but then also on aftermarket. And as far as like the interest rates and whatnot go, I think that's driven a lot of our business on the aftermarket side of things. We've definitely seen an uptick on the planter wear parts side, where we're selling those components. And I foresee that just based off of some of our early order booking continuing. So it's been very good for us. We've been blessed, but there's still some areas where we can improve.
Okay. And then, so that was looking back at the first half of the year, and now kind of looking at the remainder of the year. Have your expectations changed from what original, forecasts for the year were, and what you're kind of looking to see yet in the next 6 months? David, do you want to start us off on this one?
Sure. For us, the rest of the year, we expect to come in real close to our actual budget for the year. We've got the backlog for it now, and still quite a bit of, from our dealer perspective, they're low in inventory. So even when they fill their retail orders, they're still looking for a few pieces to put on a lot. But if we look a little further ahead going into next year, we're a bit more cautious about next year. I kind of anticipated that the first half of 24 would be fairly strong yet, and then the second half softening up. I think that softening up may come a bit sooner than that, especially as the interest rates continue to go up. While dealers are going to want some inventory, they're certainly not going to want to overload their lots with those interest rates that high. And I think you'll also see some pullback on the floor planning from manufacturers to the dealers, and some of the consignment type activities due to the interest rates. So yeah, for us, the rest of the year will continue to be strong, and then we're going to be a little more cautious as we get into fiscal 24.
Okay. Joel, do you want to take that one next?
Yeah, I'll comment a little bit on that. We're feeling good about 24, and I'll give you some details just around why and kind of some of the things that are promising. It's probably a little too early to get a firm view on 24, but the fundamentals give us a lot of confidence, and especially as we move into our early order program season, my confidence is really growing because we shape a lot of our demand with early order programs, as do many of the folks that operate in the ag industry. It's important to give visibility to our supply base, especially in the times right now with supply challenges, and growers like to make those decisions at certain times of the year. So we use EOPs to shape a lot of demand. And we opened our application EOP, sprayers and floaters, in May, a month earlier than normal this year. And we opened our planter and seeder EOP about 2 days ago. And I've just been really pleased with the results and the progress. And frankly, it solidifies what we shared publicly regarding seeing continued strong demand into 24. I think we'll know a lot more as we progress through the summer and the fall season, but feeling really good and really feeling good about the industry, because regardless where we're at in the cycle, we plan to continue to invest for the long term and continue to find new ways to unlock value. And it just seems like a really bright decade ahead of us.
All right. Mark?
Yeah, I'll echo Joel. We kicked off our early order program, and basically what we've seen, I didn't really know what to expect. Last year, we were pretty much double what we were the year before for the early order program. Wasn't sure whether to expect a slowdown or not. So we also kicked ours off a little bit early. And some of the numbers that we're seeing right now already in just the second week of that program, it's keeping us pretty optimistic based off of where we're going. That, along with most of our OE customers, have been very good to us in terms of forecasting. And some of the forecasts we're seeing have been very positive. So far from what I'm seeing, we're very pleased with. And I don't see that slowing down anytime soon in the next 6 months or so, but I guess we'll see as we go through the fall.
All right. And then Mary?
I would say, Kim, we're, cautiously optimistic right now. I think we anticipated, looking at maybe a little bit stronger remainder of the year right now, with the fact that we're in drought conditions early, and not sure when this weather is going to turn. You couple that with, commodity prices that have been retreating to a certain degree, and input prices that have not retreated at the same rate. And you put, the potential of yield concerns on top of that. And I realize that, I'm speaking a little bit more geographically here, but, farmers are looking closely at, profitability and their profit margin today when they're making investments, and they're, certainly measuring their return on investment, and driving is what's driving the purchases. And it's in needing to be, it's a critical decision in their operation. So I think there's also a few other recessionary, pressures that we see with in other ways. So, I think that we still feel like the demand and the replacement is still there for sure. But I think that we're, cautiously approaching that given some of the conditions that we're facing, right now.
All right. And we just got a well-timed question from the attendees. My next question was going to be about kind of expectations for early order programs. Theirs is a little more specific, so I will share this one with you guys. Does your early order program offer a financial incentive to the customer, i.e. a discount? And if so, what kind of discount level? Or is it more about getting a place in line to get what they're wanting? And I will let whoever wants to start with that one jump in.
I can go first on that. For us, it's a bit of both. So, we just finished an early order program here last week, and we'll have a second one that starts later this year in the late fall, going through the winter. And there's a financial incentive to order on the early order program. But that financial incentive drives the sales, but then it gives us insight into what our orders are going to be, help us do our planning, schedule our production. accordingly to meet that demand. Obviously, under current supply chain situation, we're having to forecast well ahead of what the early order program is to make sure we got parts. We have some stuff that's well over a year out that we've got to order ahead of time. So we're really taking our best forecasts even before that EOP program starts. But certainly, yes, the financial incentive helps drive the sales. But the big benefit to us is the ability to plan the production and try and be as efficient as we can in that manufacturing process.
Yeah, I would add, I would say the same. I mentioned a lot of our business for many of our products, not all, but many is driven by early order programs. And if we want to get a high percentage of early order programs orders filled up, obviously we have to create and shape that demand and provide rewards for folks to make those decisions at that time. And we need an early order program period to be at the right time so that we can line up our factories and get our supply base prepared. But we also want to make it the best time to buy for a customer. And so we do that. We make sure that it's the most lucrative time for a customer to buy. It's also, though, about getting a place in line. And, especially when demand is where it's at. And we work through a variety of different models to ensure that we have an equitable approach in doing so. For example, we've been allocating to dealers a combination of allocation and open ordering in other cases over the last couple of years. And we'll continue to do that as we see demand be robust. It's, we see it as our responsibility to ensure that all dealers are treated equitably and that we can base their allocations based upon real data that they can understand and calculate themselves too. So yes, kind of all of the above, just to reinforce what was just said.
Yep, I'll go ahead and echo Dave and Joel as well. That's pretty much the same as what we're doing. We're running ours through the summer, basically into September. Gives a little financial relief to both the dealer, but also the end user then as well, especially because most of our parts are wear parts. So guys that are looking to rebuild units, especially planting equipment right now, as everybody gets out of the fields from plant 23, that's kind of what we're looking at. And as Dave touched on, us as a supplier, any of the forecasting that can be given to us really helps. So that's what we're trying to push. Not so much that we want everybody to open up their pocketbooks, but that, we want to offer the incentive so that we can allocate the material with all of our suppliers as well.
Anything additional from you, Mary?
Well, just to say that, the things that they've touched on obviously are important to, the dealers. I think that, we're looking to, maybe see a little bit of moderation, in price increases as the order programs open up, given, the amount of the phenomenal price increases over the past couple of years. We know that, a lot of manufacturers that we work with are catching up. So we're seeing, lead times, improve and some of those things. So as some of these types of things, balance out and normalize, certainly, should be helpful, both to the manufacturer and the dealer, and benefit the customer, moving forward.
Okay. Then we got a follow-up question from someone related to early order programs. How many months in advance does the customer need to be placing in order to participate in an early order program?
Yeah, I can go first on that one. It really depends. I mean, the early order programs open up at different times of a year. For example, for John Deere, the early order programs for application equipment open in May. The early order programs for sprayers and floaters open in June. The early order programs for combines open in August, just to give you an example. And they may move a little bit each year, but generally it's at that time. Tractors are generally open a year round. So it really depends, but the best time to make your decision is during that early order program. That's when you'll have the best discounts. And it's early on in the early order program if you're concerned about your delivery date, for example, because obviously other folks are going to be requesting delivery dates that are going to meet their needs across the United States and Canada, and those vary from north to south pretty significantly. So you got to be talking with your dealer in advance ahead of those dates. And I would suggest even just talking with your dealer regularly and getting a feeling for how you might plan the next year. the more you can integrate your dealer into that conversation, more transparency you can have within your relationship with them, the better off you are in managing some of the uncertainties or the surprises that might happen within the year. And generally, dealers are looking for that level of trusted advisor collaboration with growers if they can accomplish it.
Yeah, for us, we're a little different where most of our EOP is, we have one EOP program with most all products on it. Some are excluded from an EOP program, but rather than breaking it down by product line, it's just kind of the timing of it. And to Joel's comment, the earlier you participate in the early order program, the better your chances are of being slotted for production to get your product in time. We tend to see that most of our orders on an early order program come in right before they are over with. Probably 70% of them come within the last week. Dealers are working retail orders, trying to finalize retail orders. Some of our EOP is volume based for dealers, so the more they order, the better the discount will be. So they tend to try and package up as much as they can. But from a end user perspective, Joel's comments about working closely with the dealer, understanding when those manufacturers are having the EOP and their timing of when they're wanting it will certainly help them plan their purchase better. We have some items that today we have a few on hand, and depending upon what features you want, we could deliver it shortly. But we have other things that are still 4 or 5 months out if you order them today. So certainly difficult to wait to the last moment to get something in today's environment. So your planning ahead is definitely needed right now.
Yeah, that's a good point, Dave. I would echo that. We, as a company, we have a focus obviously in planting, seeding, and tillage equipment is what our products go on. So we do the same. It's once a year, basically mid-May through September, and it's a lot of the same. I mean, we're trying to educate our dealers to get it out there to their growers that this is what we're doing. And like I mentioned before, it's mainly for the planning perspective of things for us. We have a lot of inputs that go into our goods. Like I said, the bearings, the castings, the steel bar stock and whatnot. So it's really mostly about planning for us. So we try to get those promotions out there to our dealers and make sure that they're well aware of them. We attend planner clinics with them throughout the summer and try to educate their growers for them as well.
Anything from you, Mary?
I don't think I have anything to, add on that particular topic, Kim. Thank you.
Okay. And then a couple of you have mentioned interest rates in your answer to the first question. So kind of turning back to that topic, what are you guys hearing from your customers, your farm customers, about how interest rates are impacting them and any purchase decisions they are making? Mary, let's start with you on that one.
Okay, sure. We've seen varying scenarios with that. It's certainly, compounded, increased, prices. So, we definitely saw a lot of sticker shock for farmers that couldn't replace, either the equipment wasn't available or they held on to it longer. And so when they priced equipment, of course, that was, surprising, to see where prices had gone. But then, the interest rates weren't as surprising to them. But when you couple the two, it's an interesting, every situation is a little bit different. So we would see everything from, the possibility that may have somebody that may have been a used buyer, but the rates for the used equipment were a lot higher, actually take a look at something new. And if there was a rate program or rate incentive, kind of penciling the whole thing out for the cost of ownership, it may have swung the deal, that direction. So you had that. You had, we even saw situations where the buyer could swallow the price increase, you get over that hurdle, but they just couldn't swallow what the interest rate was going to be. And they ended up, taking cash out of cash reserves. So they made a cash purchase instead of, financing the equipment. And then, even that there were times when, the combination of the two, would make it just unaffordable at this particular time, and lead to maybe more planning time, for that particular, farm operation. So I think it was kind of across the, sort of across the gamut, really individualized, types of decisions, working closely with your customer, to put together the best package. And, we have seen our manufacturers, kind of stepping up, programs and rate incentives, here more recently. So that's, certainly helping.
Okay. Dave?
Yeah, we're, right now, our dealers are still selling a lot of product that's been retailed. A few putting some extra pieces of equipment on inventory when they can get their hands on them. But we're certainly hearing more from dealers about them wanting to be cautious on excess inventory. Looking ahead, we have a few dealers and dealer groups that have said, they're not putting inventory of short line equipment on. They're just sticking with their main line, moving forward from an inventory perspective. To Mary's comment about using, the farmer using the cash reserve instead of financing, we've seen some of our dealers do that rather than finance inventory, or when they're working with an end user, they'll pay cash for it instead. And, the smaller, less expensive equipment, that's certainly easier for them to tackle that. Some of the larger, more expensive, that's where we're definitely seeing the, hesitation, or definitely putting some more thought into whether or not the dealer should be bringing it in for inventory, or from the farmer perspective that the dealer is working with, whether or not, we should really go ahead and get it this year. Maybe we should just, buy some parts, keep it running another year or two, look at it down the road. So we're starting to see more of that because of the interest rates, and certainly everybody's keeping an eye on what the Fed's going to do. And I think everyone was kind of hoping they would press pause a little bit. And I think the jobs report that came out last week is maybe making some of them think twice of whether they should hold it or do another increase out there. So we'll see what happens here over the next couple of months from them. But definitely the interest rates continues to be an ongoing topic, and it's rising higher on the list of concerns for people.
Joel?
Yeah, I'll just maybe give a macro perspective, because I think you're getting some really good kind of customer back views. But if you look at the macro level U.S. farm interest rate expense overall, it's about 6 to 7% of a grower's total ag production expense. And of that 6 to 7%, a little over half of that is tied to mortgages. And those mortgages, obviously, we have savvy customers and they're savvy business operators. They're generally at fixed rates and lower rates and over longer terms. So that really leaves a portion tied to operating expenses that's around 3%. If you look specifically deeper into row crop producers, that number is even smaller. And believe it or not, the average row crop producer variable interest expense is less than 1% of their overall operating expenses. So farmers are doing a really good job at managing expenses and interest expense in general in their operation. Certainly, we're facing different times and it's influencing their decisions differently, but they're in a different place than they have been in past decades. And when it comes to Deere's business, and then my role specifically, the numbers I just shared were average. And we know that each grower's situation is unique, right? Rising interest rates are a significant challenge for some customers. And as we look to go to market with our solutions, we've got to develop programming, early order programs, finance rates, retail programs that enable a grower that's feeling those pressures from interest rates to achieve their operational goals as well. So it's really a balancing act. I'll tell you, it helps us to have a finance company and a partner in John Deere Financial, where we can see the capital funding challenges that banks have. We can see the wholesale cost challenges that dealers have and what their dynamics are. And then we can understand the retail side of the transaction for the customer. And you add that into an understanding of the used business, and you really get a pretty comprehensive view on what you can do for those customers that are struggling with interest rates over time.
Anything additional from you, Mark?
Yeah, what I'll say from what we've seen as a supplier in the industry, definitely our short line OE side has kind of cooled down a little. I won't say that we're down at all on that. I mean, it's still very strong, but I will say, in terms of the interest rates, we have seen a large uptick over, I'll call it the last 7 to 8 months in our aftermarket side of the business in terms of replacement parts, especially wear parts on the planter row units. That's gone quite a ways up from what we even expected. So I take that as you will, but that's just kind of what we're seeing.
All right. And then anything in terms of how, from any of you, the interest rates are impacting your own businesses and what you have going on? Or from either David or Joel, what you're hearing from how it's impacting your dealer's business?
Yes, certainly we see interest costs increasing. We see wholesale interest costs increasing for a dealer. But our dealers have evolved into very savvy managers of equipment and balance sheets, because that's the quickest way to have challenges as a dealer, is not know how to manage a balance sheet and use equipment. So they become very proficient at it. They've got a lot of tools to manage it, a lot of flexibility to manage it. And we're seeing turn in demand for used equipment being extremely strong still. So, we got a ways to go in this year and into next year, but our overall perspective on it is still pretty positive, as you would hear from our dealers overall.
Yeah, I would say for us, interest rates, we don't have our own finance company like John Deere. Obviously, we're not that size. So, if we're financing something, we're pretty much obviously doing it on our own. And if we're doing any type of floor planning or consignment program with the dealer, the higher the interest rate goes, that certainly makes it more difficult for us to floor plan or consign a whole lot more product. And we got to take a look at our early order program and what some of our discounts are. And if we are going to floor plan or consign something to a dealer, that does have to be paid for somehow. So it would affect some of our early order program structure and discounting to account for that. But certainly we keep an eye on that from the overall business perspective and how we run the business and what we want to do. Even from a capital expenditure standpoint, there's some things that we take a look at, and we're certainly holding off on it at the moment to see what happens with interest rates. So we're just like all businesses, keeping our eye on it and being cautious about it.
Mary?
Well, I think, we covered, everybody covered that well. And obviously, it is really important that, we manage that well, with early order programs and how we approach them. Farmers are certainly planning ahead further. So, managing, looking at your pre-sale, activity, from that side of it, and also just doing a good job of, managing trades and managing, the used equipment, inventory as the climate, things change a little bit. I think that, we're positioned well, moving into whatever this next phase is, but certainly continuing to keep tabs on it as the dynamics of the market change.
Okay. And then this next, Mark, did you have anything additional on it?
I think we're good. I think they touched on it well.
Okay. So this next question probably will be easiest to answer for Joel and Mary, but David and Mark, if you have input, by all means, jump in as well. So how do you assess the customer's readiness to move to greater advanced technology in the product? So autonomy, electrification, things like that? And are you hearing any feedback on adoption? What's your likely timeline of the inflection point?
Well, I can jump first if you'd like.
Okay.
I think about it. We've seen a lot of growth in precision ag, and we'll continue to see a lot of growth in precision ag, and that's driving just a ton of progress in our industry. I would say that I look at it as what's coming in the next 5 years that you need to be ready for, and what should you be doing now to get there, and when are you ready? And I really see 4 key areas that are going to change significantly relative to technology as we go forward, that farmers need to be thinking about and positioning themselves, and dealers need to be preparing their customer base for. The first is automation, and that's been going on for a long time. And we're working closely with customers and have been, as are many other manufacturers. But we expect that equipment will continue to become more automated. And if you just think about where we were 20 years ago with AutoTrack and hands-free steering, and I remember sitting in a cab with customers trying to explain the value of that. And now you look at where we're at with AutoTrack and auto steering technologies. It's in base of every large ag piece of equipment that John Deere produces. So it's, as tasks become more automated and widely accepted, you're going to see features move into base equipment. It's going to raise the values of those equipment, and it's going to push that into the mainstream. So automation's one. I think automation will lead to autonomy, and that's the exciting topic everyone always asks me about. And I think autonomous machines will become much more widely adopted. And in its current form, this technology really can be bolted on to platforms that folks are really familiar with, like our 8R tractor today. And that tractor's been proven with customers. They're very familiar with it. And outfitting that with autonomous perception systems that are integrated with the controls of the tractor is going to scale that very quickly across farms once they trust it. So that's 2. 3 would be sense and act technology. And I think you're going to see more and more equipment come out with sense and act technology that enables plant level management, and things like See and Spray. That's been out in the market for a couple of years now. And to take full advantage of those advancements, farmers are going to need to begin preparing their operation now, whether that means using documentation and mapping their fields, or using guidance, maybe if they're at a very remedial level. But they're going to need to be moving up the steps of moving from automation to autonomy to a sense and act space. And then lastly, briefly, would just be alternative power sources. I think that we will see changes in the way products are propelled and operated. And we're always looking at that. And I hope we'll get a chance to talk about electrification a bit. But, things like electrification, hybrid power, fuel cells, those are all things that are on the horizon for different product segments, not all for ag, just different product segments. So lots of exciting things ahead of us, but an opportunity for change management probably for a lot of growers.
Mary, do you want to take that one as well?
Sure. Well, and to just kind of, if you think about, the conversations that you have with your farm customers, it's, how does this add value to my business? And today, does it save time? Does it make me more efficient? Does it save me labor expense, input costs, performance results, maybe at harvest? So everything that, Joel just talked about, and, kind of translating into all of those dynamics that the farmer's looking at. And I think that the adoption rate and the fact that there are labor challenges, on top of, all of the other benefits, the cost, that there's, certainly the return on investment is there. So I think that, we're seeing the adoption of technology come at a faster and faster, pace, and that will continue.
Okay. David, from a short line perspective, anything to add on that one?
Yeah, since we don't make anything with an engine in it, we make implements. We're not driving an autonomous, project design or anything like that. But for us, we definitely have to pay attention to, what is going on. Joel's comment about the more automated it gets, the more we head into autonomy. what does that mean for an implement manufacturer, and what do we have to change to interact with, an autonomous tractor? If you've got somebody driving a tractor, they're, watching the implement, what's going on, is there any issues, that type of a thing. As soon as you remove that driver, we've now got to start thinking about, well, what type of sensors do we have to have in place to notify, the tractor, or maybe the operator who's back in their office, running this equipment, or they're in the next field over running it. We've got to be able to, point some of those things out, and let either the tractor or the remote operator know what's going on. So those are the types of things that we have to take a look at as we move forward. And certainly Mary's comment about labor challenges, we're all fully aware of that. Certainly from manufacturing all the way down onto the farm, and being able to, find the help to do the farm work. And so autonomy and automation is certainly going to move forward, and it's just going to get, speed up every year. Joel's comment about 20 years ago with auto steer and that type of technology, and it's commonplace today. I think we're going to see that adoption rate just escalate.
All right. Any impact on the supplier aftermarket side, Mark?
Oh, I'd just say on the supplier side for us, as far as automation goes, that's part of the reason we built a new facility. Just some of the labor issues that we faced the last few years, we really pushed a lot of our manufacturing, especially machining, into automation, and it's helped us out substantially. And I think we're going to continue to push that way. It's kind of an unknown of what to expect anymore in the labor pool. So as it continues that route, from what we've seen from automation and the impact on our business, I think that's something that's just going to be more and more integrated.
Okay. And then Joel brought up electrification. Any outlook or insights onto where, what parts of agriculture is that going to be adapted to best? Is it possible? Is it, this is huge equipment. Can that transfer be made to electric? What are you guys either seeing in your own business for opportunities there, or hearing from customers or dealers? Joel, do you want to start, since you expressed interest?
Yeah, the thing that I think about with electrification, it actually surprised me. I was at CES this last January talking to consumers that don't know anything about agriculture, right? That's the whole reason we're there, to advocate for our industry. And I was surprised, and I expected it to be high, but I was surprised at how many comments, questions, inquiries we had on electrification of equipment, and really the expectation that everything either was already or was on its way to be electrified. And so what we do is we look at it from what customer pain point are we trying to solve, and what value can we deliver? And that's a really good place to start. But there's lots of technologies that we can use. But when you look at the customer segments we serve, energy requirements are needed for the propulsion of equipment and the powering of implements. And the use cases between a lawnmower and a four-wheel drive tractor or combine are vastly different, right? So we look at it in two categories, and I'm going to be pretty specific because I think it's important that kind of get expectations aligned from what you'll at least see from us. The first piece is the ability to propel the machine with battery electric propulsion, right? Like your Tesla or something like that. The second is to electronically enhance implements that unlock greater precision in the field or efficiency for the job in the field. And the near-term opportunities for battery-powered equipment, so like the Tesla, is turf products and small horsepower tractors. And we've indicated that in our LEAP ambitions that we share publicly as a company every 4 years. And we frankly have said we plan to maintain offerings for battery electric options in those turf and small tractor categories. And in our construction and forestry division, our sister division has revealed the 145X tiered excavator at CES. They also have shown 3 versions of battery electric machines at ConExpo. It was a backhoe, a dozer, and a wheel loader. So it's happening in that compact consumer equipment, compact construction equipment space. We also introduced the new electronic Z-Track in February. So those small pieces make sense. But when it comes to tractors, combines, sprayers, self-propelled forge, all of that stuff, we have absolutely no plans to use battery electric power in large ag equipment. What we will do in ag is continue to investigate opportunities to electrify implements or functions on those implements or functions on a self-propelled machine to generate higher levels of precision and help folks do the job better. And the example I would give would be exact emerge planter row units. The ability to control the seed meter, control its movement down through the brush belt into the trench, and then be able to understand what's happening at a high speed, document it, ensure we have uniform emergence and greater yields. That's what I think you'll see in large ag applications. You'll see folks using alternative fuels, hybrids, other types of fuel sources, but for electrification in large ag, it will be implement and onboard self-propelled features.
Okay. Anyone else have anything to add to that?
Well, even though we don't make anything self-propelled, at this point today, we still get the questions and comments, from dealers, farmers. What do we think about electrification? And we hear some of the feedback from farmers, and what Joel mentioned, what Deere is doing, focusing on the smaller equipment for electrification, and the larger ones not so much. And that's the same thing that we hear from farmers when that topic comes up of electrification. The big tractors, the combines, that type of thing. When I'm running, I'm not stopping to charge anything up, and I've got a short window of opportunity to operate in. So they all express concerns about their large equipment being electrified. Now, they're also more interested in hybrid type stuff. So what can we electrify? But also alternatives like what will the major OEMs come out with hydrogen fuel cells and stuff rather than with diesel and that type of thing. So even though we're not heavily involved in any of that, just by the nature of the equipment we make, we certainly do hear those comments from dealers and farmers. And I think Joel, comments reflects what those individuals are saying and what Deere's strategy is with it.
Mary, anything you're hearing from customers on whether they want to see it happen or don't?
I would say, that I don't hear that much in terms of the large ag, very similarly to what Joel said, more on, the turf side, and, some of the consumer market. The other area that I would say that we've heard, more outside of ag is maybe municipality business, because there are a lot of municipalities, cities with certain mandates, in place for, either electric vehicles or some type of movement, toward, that alternative energy source by a certain date. So that would be the other, space that, we hear some buzz about, electric or alternative fuels. So, but mostly electric right now.
All right. We are at 3:00. So I've got one last question for each of you, for everyone in the group, and then we'll start wrapping things up. So Mark, we'll start with you, but just wondering what each of you see as the biggest challenge for the ag equipment industry in the year ahead. So next 6 to 12 months.
I would say for us, it is what it has been for the last 24 months or so. It's definitely labor. If we could get a consistent labor pool, it would help out with a lot. Even though we're investing in automation, we continue to bring those machines in. The problem is you have to have a labor pool that's educated to run those machines. And then general laborers, that's where we've really struggled. In terms of, we do all the assembly at our plant as well. So any of the products that we send out, it's not just a cast machine part or a piece of steel that's machined. We do complete assembly of units that we send to either our OE customers or our dealers that's ready to bolt onto their toolbars, their row units, their piece of machinery. So we typically have a fully staffed assembly department, and we can run 2 to 3 lines of either aftermarket or OE product. And it has, over the last 2 years, been a consistent flow of new labor. And that's just the competing area we're in geographically. There's a lot of other machine shops in Northeast Ohio that we're competing with, along with a lot of other industries. So it's been difficult from that standpoint. And then I'd also say, even though it's gotten a lot better, and we are a supplier ourselves, the supply chain still is kind of unknown. It's definitely gotten a lot better, but it's still not where we saw it pre-COVID. And, it's kind of hard to be optimistic about it because you don't know when the next price increase is coming, and you don't know when lead times are just going to soar out again. So I would say those two things, that's the biggest challenge for us as a supplier.
Okay. Mary?
I've realized, and I know that we discussed a lot of different things, but, I think that, from an industry perspective, I do think that, some of the labor shortages out there will continue to drive, some of the operational, decisions and technology purchases. I do think that, another challenge is some, with the supply chain disruption and some of the, rush to get, equipment here, what we've seen is some quality control lapses where we haven't seen, those types of things before, failures in certain things that, were not really the normal place that we would see something. So will that continue? What will that look like, moving forward? I do think, there's some challenging, just kind of looking big picture, a challenging, we're actually hearing from customers already just concerns over the political climate, tempering their decisions, moving forward. And, I realized that, we're months out, but, it's still, there's still the issue in the Ukraine. There's still, global issues around. So there's still like elements of concern that I feel like are tempering decisions. And then just watching, we're seeing some change in, kind of the tide turning a little bit in things, and making sure that, we are managing used equipment well. You're starting to see auction reports where, the number of units are increasing, like 4 to 9%. They were up in April. They were up again in May. So just, kind of thinking forward, looking forward to that, and making sure that, we're managing that well as the tide turns. So I've kind of some big picture things, and then, some more, ground level things at the same time.
Okay. David?
Yeah, what Mark said, definitely the labor continues to be a challenge for us. I've already mentioned supply chain. Mary mentioned earlier a different question just about some of the commodity prices softening up, and while inputs have come down, not keeping pace with that as well. Looking ahead, what is that going to affect? For us, cattle prices, sugar prices are still doing well, so that definitely helps. Obviously, we'd like to see corn, soybeans, and wheat come back a little bit and stay up. So that is a little bit of a concern. Just kind of keeping an eye on that. I mean, we all know that commodities fluctuate, and haven't heard too much on the political side yet, but I think we all know we're going to hear a lot about that here shortly. So we'll all get to hear the opinions of everybody again as we get into that type of season, election season coming up again. So, but yeah, for us, definitely labor, supply chain will continue to be strong challenges with us. And Mary, you did bring up an interesting point about quality. Even though as a manufacturer, something we have to pay close attention to. We have noticed some supplier issues with quality that we've got to pay, closer attention to. And, obviously a lot has to do with the labor challenge. And if you short of labor, if you got new people coming and going all the time, it's a bit tougher to make, get some of that tribal knowledge passed along. So interesting comment by you that we see some of that with some of our suppliers as well, that we've got to, manage and help mitigate some of that also. So.
All right. And Joel.
Yeah, I think all great points. There's so many things. The list of things to worry about is very long. I mean, whether it be weather, labor, rising input costs, supply management challenges, you name it. One of the things I guess that stands out to me that keeps me up at night is just the need for us as an industry to work together to advocate and educate the public on the work that our customers do to help feed, clothe, and fuel the world. We just really have to double down on the education of the public and policymakers about the sustainable farming practices that our customers have been doing for a long time. And, no one loves their land more than them. And they're the ultimate stewards of the land because they rely on it for their livelihood. And getting the message out to the rest of society that does not know where their food comes from, and there are many that think it just shows up on the grocery store shelves. That's a really important opportunity for our industry. And it's one that we are certainly going to be focused on as we go into the rest of 23 and into 24.
Okay. Well, thank you again to all of you for joining us. We really appreciate the insights you guys were able to share with us during today's discussion. Thank you again to Performance Brokerage Service for their support of today's event. We are getting started on our planning for the 2024 Ag Equipment Intelligence Executive Briefing. So if anyone has topics they want to see us cover in that, people they want us to invite to be a panelist on that, please reach out to me directly and let me know about that. We're excited to get going on that. With that, I hope everyone enjoys the rest of their day, and thank you for joining us.